December 10, 2025, Shanghai. A warehouse manager walks through rows of industrial shelving in the Shanghai Futures Exchange Vault. He's looking at approximately 688 tons of silver. That's it. In early 2021, this same vault held over 3,000 tons. The shelves are roughly 78% empty. And he's got 50 industrial buyers demanding immediate delivery. Some are offering premiums of 15% above spot price just to secure supply. They can't wait. Their production lines will shut down without it. 3,000 miles west, in London. Something unusual is happening. Silver lease rates, the cost to borrow physical metal, just hit 39% annualized. That's the highest on record ever. When lease rates spike like this, it means one thing. Nobody wants to lend their silver because they're not sure they'll get it back. The physical metal has become more valuable than the paper promises. And here's what makes this truly remarkable. Someone started air freighting silver across continents. Let me repeat that. Air freight. For a metal that normally ships by ocean because it's heavy and freight costs eat into margins. When you're air freighting silver, you're not optimizing for cost. You're optimizing for time. You're in panic mode. I'm not a financial advisor. This isn't financial advice. And I'm not affiliated with anyone mentioned in this video. What I am about to show you is purely educational analysis based on publicly available historical data and current market conditions. But here's what fascinates me about this moment. This exact pattern has appeared 3 times in the last 100 years, 3 different eras, 3 different crises, and each time, silver didn't just go up, it exploded. We're talking documented gains of approximately 200%, 900%, even 3,700% in some cases. 1933, government intervention, silver nearly tripled in 2 years. 1971, the collapse of the gold standard. Silver multiplied roughly 37 times over the following years. 2008, financial crisis and unprecedented money printing. Silver went up approximately 5 times in 3 years. 3 times. Similar stages, similar outcomes, and right now, we're watching what appears to be the 4th cycle forming. But this time, the pace seems faster than ever before. The stakes appear higher. And the physical shortage looks more severe than anything we've seen in the previous 3 cycles. Think of it like musical chairs. Stage 1. Everyone's dancing, music's playing, everything looks normal. The game hasn't started yet. Stage 2. Someone quietly starts removing chairs. Nobody notices because they're focused on the music. The dance continues. Stage 3. The music stops. Panic. Everyone realizes there aren't enough chairs. The scramble begins. Stage 4. Chaos. It's a fight for the last seat standing. Winners and losers get decided in seconds. That's where many market watchers believe we are right now. The music just stopped. China's vaults are 78% depleted. London's borrowing costs hit records. And there don't appear to be enough chairs. Let me show you why this pattern matters, but I'm not going to drag you through dense economic textbooks or boring charts with no context. I'm going to walk you through the exact moments when everything changed, the days when governments made decisions that altered the course of financial history. The moments when silver became something more than just a metal. Before we go deeper, I need you to do something. Hit that subscribe button right now. Tap the bell icon so you don't miss what's coming next. And drop a comment below telling me where you're watching from and what time it is where you are. I want to see how global this audience really is. Because what we're about to discuss, it doesn't just affect one country or one market. This is a global pattern. And if history repeats, what happens next could be one of the most significant wealth events of this decade. Go ahead, I'll wait. April 5, 1933, the United States. Franklin Roosevelt signs Executive Order 6102. It wasn't a suggestion. It wasn't voluntary. It was a legal mandate, according to historical records. Every American citizen was required to turn in their gold to the government. The price was fixed at approximately $20.67 per ounce. You didn't negotiate. You didn't get a choice. You complied or you faced serious legal consequences. including fines and potential imprisonment. But here's what most history classes skip over. The government didn't stop with gold. The Silver Purchase Act of 1930 for COMEX, the U.S. Treasury, started buying silver at artificially high prices. Why? Because controlling the metal meant controlling the money supply. The government needed to expand the monetary base during the Great Depression, and silver was the tool they used to do it. What happened to the price? Silver went from around 25 cents per ounce in late 1930 to approximately 50 cents by 1934 when Roosevelt nationalized it. Within 2 years, it climbed to roughly 81 cents. That's more than triple the bottom price in less than 24 months. Why did it move so dramatically? Physical scarcity. The government bought up massive quantities. Private holders sold. Industrial users competed for what was left, and the price responded to the squeeze. It wasn't about silver suddenly becoming more useful. It was about supply and demand fundamentals colliding with government intervention. Fast forward 37 years. August 15, 1971, Sunday night. President Richard Nixon interrupts regular television programming with an emergency economic address. He announces the United States will no longer convert dollars to gold. The Bretton Woods system, the foundation of global finance for 26 years, ended in a single sentence. The gold window closed. Why did Nixon do this? Because foreign governments were depleting Fort Knox. They'd been exchanging paper dollars for real gold. And according to official records, U.S. gold reserves had dropped from approximately 20,000 tons after World War II to just 8,000 tons by 1971. The system was breaking. Nixon chose to break it first on his terms rather than let it collapse uncontrollably. What happened next changed everything. Gold exploded from around $35 per ounce to $850 by January 1980. That's roughly a 2-4x gain. But silver went parabolic. From approximately $1.29 per ounce in 1965 to around $6.70 by 1974. Then it accelerated. By January 1980, silver touched $48 per ounce. From $1.29 to $48. That's approximately 37 times in 15 years. A 3,700% gain. Now, some analysts will tell you the Hunt brothers manipulated the 1980 spike. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, started accumulating massive amounts of physical silver and futures contracts in the mid-1970s. By 1979, they reportedly controlled over 100 million ounces, roughly half the world's deliverable supply. The price spiked. COMEX intervened with new trading rules that limited contract positions and increased margin requirements. The Hunt brothers couldn't maintain their positions. Silver crashed back down. But here's my perspective. The Hunt brothers didn't create the trend. They rode a wave that was already building. The fundamentals were already in place. The monetary system had shifted. Governments were printing money. Inflation was rising. Investors were fleeing paper currencies into hard assets. The Hunts amplified the move. They didn't cause it. The underlying pattern was structural, not speculative. September 15, 2008, Monday morning. Lehman Brothers, the fourth largest investment bank in America, files for bankruptcy. It disappears overnight. Within weeks, the entire global financial system is on life support. Banks stop lending to each other. Credit markets freeze. Stock markets plunge. The world faces a crisis that looks, for a moment, like it might be worse than the Great Depression. Governments respond with unprecedented intervention. The Federal Reserve's balance sheet reportedly went from around $800 billion in 2007 to over $4 trillion by 2015. Other central banks followed. The European Central Bank, the Bank of Japan, the Bank of England, money printing on a scale never before seen in peacetime. Investors noticed. They started buying physical gold and silver. Coin dealers ran out of inventory. Mints couldn't keep up with demand. Premiums for physical metal spiked above paper prices. By April 2011, silver hit approximately $49.83 per ounce, from under $9 in November 2008 to nearly $50 in April 2011, silver quintupled in less than 3 years, or roughly 450% gain, 3 times. 3 different crises, 3 explosive moves in silver, but here's what should make you pay very close attention right now. Notice how each cycle appears to take less time, 1933 to 1935. Approximately 2 years, 1971 to 1980, 9 years, 2008 to 2011. Less than 3 years, the cycles are accelerating, the moves are happening faster. The market is becoming more responsive to monetary shocks and supply disruptions, and the current cycle, it reportedly started in March 2020 with COVID stimulus and money printing. We're 5 years in, and many analysts believe we just entered stage 3. The music stopped. Let me show you exactly what's unfolding right now. Not speculation, not theory. Verifiable data from exchanges, government agencies, and commodity markets. March 2020, COVID hits. Governments around the world reportedly print over $20 trillion in 18 months. The U.S. Federal Reserve alone expands its balance sheet by nearly $5 trillion. That's more money created in a year and a half than in the previous century combined. But something else is happening quietly in the background while everyone is focused on lockdowns and stimulus checks. Industrial demand for silver is surging. Solar panels. Each gigawatt of solar capacity reportedly requires roughly 10 tons of silver. That's about 320 ounces per gigawatt. China installed over 250 gigawatts of solar capacity in 2024 alone. That's potentially 80 million ounces just for Chinese solar in 1 year. And China isn't slowing down. The European Union aims to deliver at least 700 gigawatts of solar capacity by 2030. Global solar installations are accelerating. Electric vehicles. Every EV uses approximately 25 to 50 grams of silver. That's roughly 1 to 1.5 ounces per vehicle. Traditional internal combustion engine cars use about 15 to 28 grams. EVs require 67% to 79% more silver. Production is ramping up globally. Millions of EVs rolling off assembly lines every year, each one consuming silver for battery management systems, power electronics, charging infrastructure, and electrical contacts. 5. Infrastructure. Add data centers, consumer electronics, new technologies that didn't exist 10 years ago. All of it requires silver for its unmatched electrical and thermal conductivity, according to industry reports from the Silver Institute. Global industrial demand hit a record 700 million ounces in 2024. That is a 7% increase from the previous year. Industrial fabrication demand is at an all-time high and still growing. But here's the critical problem. Total global mining production in 2024 was approximately 820 million ounces. That sounds like enough until you realize total demand exceeded 1.2 billion ounces. Where did the other 380 million ounces come from? Existing stockpiles, recycling, inventory drawdowns. The market has reportedly been running a deficit for 7 consecutive years. Cumulative shortage from 2018 to 2024, over 800 million ounces. That's nearly a full year of global mine production that's been drained from above-ground inventories. But prices stayed relatively suppressed for years. How is that possible? The paper market. For every physical ounce of silver, there are reportedly between 100 and 400 paper claims, futures contracts, ETFs that may not have full backing, derivatives. Banks hold massive short positions on COMEX, selling contracts promising to deliver silver they may not actually possess. This paper trading keeps prices artificially low because it creates the illusion of supply that doesn't physically exist. Until something breaks. And in late 2025, something started breaking. China had been accumulating silver for years. They were a net importer, buying up physical metal and storing it in Shanghai vaults. Then suddenly, in October 2025, they flipped. China exported over 660 tons of silver in a single month. That's approximately 21 million ounces, the highest monthly export volume ever recorded in history. But here's the key question. Why would China, which has been buying silver for years, suddenly dump 660 tons in 1 month? Did they decide silver wasn't valuable anymore? Did they change their industrial plans overnight, or was there another reason? Most market analysts believe those 660 tons didn't ship because China had excess supply. They shipped because London was in crisis. The London physical market was reportedly running dry. Vaults were depleting. Lease rates were spiking. Someone in London needed physical metal urgently and was willing to pay whatever it took to get it delivered fast. How do we know London was in trouble? The signals were everywhere. Lease rates exploded. When lease rates go from under 1% to 39% annualized, it typically means one thing: physical scarcity. Lenders don't want to part with their metal because they're concerned about getting it back. The metal itself becomes more valuable than the interest income from lending it. Then traders started air freighting silver. Normally, silver ships by ocean in containers. It's heavy. Freight costs matter. You optimize for cost efficiency. But when you start air freighting a commodity as heavy as silver, something is very wrong. Air freight costs significantly more. The only reason you choose air freight is when time matters more than money. When waiting 2 weeks for a ship isn't an option. When you need that metal now. In late 2025, the U.S. government designated silver as a critical mineral. This isn't just symbolic language. Section 232 tariff investigations followed. The government is considering import duties ranging from 15% to 50%, and the United States reportedly imports 64% of the silver it consumes. If tariffs get imposed at 25% or 50%, imported silver could become dramatically more expensive overnight. What happens when industrial users realize tariffs might hit? Precautionary buying, panic accumulation. Approximately 75 million ounces have reportedly flowed into U.S. vaults since October 2025. That's according to exchange data and industry estimates. Industrial users don't want to get caught without supply when tariffs potentially double their costs. Solar manufacturers need silver now. EV producers need silver now. Electronics manufacturers need silver now. Production lines shut down without it. They'll pay premiums to secure supplies before tariffs hit. Meanwhile, back in China, the depletion continues. Shanghai Futures Exchange inventories dropped to approximately 688 tons as of early December 2025. That's down from over 3,000 tons in early 2021, a 78% decline. Shanghai Gold Exchange silver volumes are at the lowest level since 2015. The stockpiles are vanishing. And here's the signal that makes market analysts sit up and pay attention. The Chinese spot price is now trading at a premium to New York. Shanghai silver around $60 per ounce. COMEX silver around $58. That premium typically means one thing: the paper game is breaking. Physical metal in China is worth more than paper contracts in New York. When the physical market and paper markets start diverging like this, it's a warning sign. It means there may not be enough real silver to satisfy all the claims. We appear to be in stage 3 right now. The music stopped. People looked around. They realized there aren't enough chairs. And the scramble has begun. Now, some analysts will tell you China's going to release hidden reserves. They'll stabilize the market. Everything will calm down. Maybe they're right. But here's my question. If China has massive hidden reserves, why would they drain their public stockpiles by 78%? Why would they export 660 tons in a single month when they could wait and sell at even higher prices later? The shortage is real. The behavior doesn't match the narrative. Either the reserves aren't there or they're being held for strategic reasons that override short-term profit. Either way, the physical shortage appears real and immediate. This is where it gets truly interesting, because we're not at stage 4 yet, but many of the pieces appear to be falling into place. Right now, there are reportedly over 800 million ounces of silver in open paper contracts on COMEX. That's the notional amount of silver that futures contracts represent. Physical inventory available for delivery on COMEX, approximately 300 million ounces. And only a portion of that is registered, meaning available for immediate delivery against contracts. That creates a leverage ratio. If even 20% of contract holders demand physical delivery, some analysts believe the system could face serious challenges. COMEX might have to settle contracts in cash rather than physical metal. And when that happens, trust in the paper market could evaporate. Investors and industrial users might realize the paper promises aren't backed by real metal. Then what happens? Panic buying of physical. Premiums explode. The paper price and physical price diverge completely, and anyone holding paper contracts instead of physical metal finds out their silver doesn't actually exist. Industrial users are already nervous. Solar manufacturers need silver now, not next quarter, not next year. Now, production lines run on tight schedules. If silver supplies get delayed or interrupted, factories shut down, workers go home, revenue stops. They'll pay significant premiums to secure guaranteed delivery. They'll sign long-term contracts at prices above spot just to lock in supply. That behavior is already starting to show up in the market. Then governments might step in. When silver hits $75 or $100, politicians start asking questions. They launch investigations into market manipulation. They consider export restrictions to protect domestic supply. They might impose price controls or rationing, and each of those actions makes the shortage worse. Because it signals to everyone paying attention that this shortage is real and serious. The government is concerned. That triggers more panic buying. Where do some analysts believe silver is headed? Analysts like Larry Lepard have publicly stated they're targeting $75 by mid-year, $80 to $90 by year-end 2025. Philippe Vilhena at BNP Paribas reportedly told CNBC he sees silver over $100 by the end of 2026. These aren't random predictions. They're based on supply-demand fundamentals, deficit projections, and industrial consumption trends. But that's the base case. There's a possibility we could see something more dramatic. If COMEX faces delivery defaults, if governments impose export bans, if investors flood into physical metal all at once. Some projections suggest we could see $120 to $170 by summer 2026. That would represent approximately a 100% to 200% gain in less than 2 years. Does that sound extreme? Remember the historical precedents. In 1979 to 1980, silver went from around $6 to $48 in 14 months. That's approximately a 700% gain in just over a year. In 2010 to 2011, silver went from roughly $17 to $49 in 10 months. Around 188% gain. Explosive moves aren't unusual for silver. They're part of the historical pattern. And here's the context that makes this moment potentially unique. When you adjust the 1980 peak of $48 for inflation, that's approximately $178 in today's money. We're at $58 right now. We haven't even reached the inflation-adjusted all-time high yet. Silver at $58 may not be expensive. It could be artificially suppressed for decades, finally catching up to where it should have been all along. So how should you think about positioning? I'm not telling you what to do. I'm not a financial advisor. But here's how different investors are approaching this situation. If you believe China's vaults are truly depleted, and this pattern is completing right now, some investors are focusing on physical silver coins, bars, allocated storage where you own specific identified metal. They're avoiding paper ETFs that may not have the full backing they claim. They're securing positions before potential tariffs hit and premiums spike even higher. They're treating this like the last chance to get in before stage 4. If you think the shortage is real but maybe not as severe as some data suggests, some investors are taking a more moderate position, diversifying across precious metals, gold, silver, platinum, setting price alerts for key levels like $65, $75, $90, watching the signals closely, reassessing as new data comes in. They're positioned but not all in. They're ready to add if the situation escalates. And if you're skeptical, that's completely fine. Markets reward skepticism as often as conviction, but even skeptics can watch the signals: lease rates, COMEX inventories, government actions, Chinese export data, industrial demand statistics. The pattern doesn't require you to believe in advance. It just requires you to pay attention when the evidence becomes undeniable. And if you wait for absolute certainty, you'll be buying at stage for prices when everyone else has already figured it out. Now let's be honest about what could go wrong. Because every investment thesis has risks, China could release off-exchange reserves we don't know about, invisible inventory that suddenly appears and floods the market. Demand could collapse if prices hit $100 and industrial users accelerate their substitution efforts, finding alternatives to silver faster than expected. The economy could crash in a deflationary spiral where asset prices fall and cash becomes king. Temporarily, government intervention could suppress prices longer than anyone expects through market manipulation or emergency measures. Those are all real possibilities. But here's my perspective on the risks. Physical shortages don't care about paper prices. If there's genuinely no metal to deliver, the paper game ends regardless of what governments want. And if the economy crashes, what do governments do? They print money. They stimulate. They intervene. Every major crisis in the last 50 years has been met with monetary expansion. And when they print money, hard assets rally. That appears to be the historical pattern. Crisis leads to printing. Printing leads to inflation concerns. Inflation concerns drive investors into physical assets. The cycle repeats. As of early December 2025, silver recently set a new all-time high above $61 per ounce. It's currently trading around $58 to $60, consolidating near these record levels. But that's not the key story in my view. The real story is what's happening in the physical market. China's vaults reportedly down 78% from peak levels. London's lease rates at the highest ever recorded. U.S. government declaring silver a critical mineral. Approximately 800 million ounces of cumulative deficit over 7 years. Air freight for a commodity that should ship by boat. Paper leverage at roughly 20 to 1 on COMEX with limited registered inventory for delivery. Those aren't random data points. Many market analysts believe those are warning signs that appear right before stage 4, right before prices move in ways most people won't believe until it's already happened. Remember the musical chairs analogy at the start. We appear to be past the part where the music stops, where potentially in the scramble, people are realizing there may not be enough chairs. And the last person standing might pay whatever it takes to secure a seat. You ask me which historical example this mirrors most closely. Here's my answer. All three. We have elements of 1933's government intervention with tariffs and critical mineral designations. We have aspects of 1971's monetary system strain with ongoing deficit spending and currency concerns. We have characteristics of 2008's financial instability and massive money printing, all three patterns potentially converging simultaneously. That's why this cycle could be bigger than anything we've seen before. The question isn't necessarily what happens next. The pattern has shown us 3 times. The question is, will you be positioned when it completes? If you found this analysis valuable, drop a comment right now. Tell me, do you own physical silver, paper silver, or nothing at all? Just write physical, paper, or nothing. I want to see where everyone stands. And if you know someone who needs to see this, someone who's interested in financial history or protecting wealth or understanding market cycles, share this with them. Because what's potentially coming could separate people who prepared from people who waited for mainstream confirmation that arrives too late. Thanks for watching. I'll see you in the next one.